I believe that tax matter is what everyone should pay attention to because taxes remains the highest expense for Canadian families. Check out this newest study by the Fraser Institute in 2023. The study reveals that an average Canadian family with a household income of a little bit above $109,000 paid $50,000 in taxes. This is to show you that you can make lots of money working full-time job, but after taxes, you'll be left wondering where all your money go. And you know what? Someone that made same amount of money with you can end up with thousands more left in their pockets. Now, the question is why? Why is this so? It is simple. That person understood how taxes actually works in Canada and how they can legally, reduce their tax bills. And the key word there is legally. So we are not doing anything shady here. So please stick with me because by the end of this video, you will understand how Canadian tax system actually works, how to stop overpaying and to keep more of what you earn in your pockets. And you don't have to be an accountant to know this. So I welcome you to my channel. If you're new here, my name is Comfort and here I share topics on investments, on personal finance, personal development and business. And thank you for clicking play when my video popped up. So let's dive in. Now, from experience, what most people do is to, work, file their tax through a tax person or with an app, hit the submit button and then hope for a refund. But when you realize how taxes actually works in Canada, it's going to change your financial mindset. So in Canada, we have to pay the federal and the provincial taxes. Federal taxes is same for everyone, but the provincial taxes depends on your province. Now, the federal and the provincial taxes both makes up your income taxes. Also, in Canada, we have the progressive tax system, meaning that the more you earn, the higher the tax percentage you pay. You probably know this, but it is only on the portion of income that falls into each tax bracket because we have tax brackets. And I'm going to be explaining this in detail because there are some, misconceptions around it. But firstly, let's see the recent tax brackets in Canada and their percentage of taxes. So I pulled this from the CRA official page so that we'll be current. And as you can see, this is effective from July 2025. And by the way, this is federal tax brackets. So for income of $57,375 or less, it is taxed at 14.5%, 15% roughly. So income from $57,375 to $114,750 is taxed at 20.5%. So whether you make $60,000 or you make $100,000, you are still in the same tax bracket and you'll be taxed at 20.5%. Now, if you make above $114,750 to $177,882, you will jump to the next tax bracket, taxed at 26%. Then from $177,882 income to $253,414, this is taxed at 29%. And income over $229,494 is taxed at 33%. Now, let me explain this tax bracket according to how much you earn. So let's say you make $160,000. Your first $114,750 will be taxed at 20.5%. Now, the balance, which is $45,250, will jump to the next tax bracket, which is taxed at 26%. And this is only for federal tax. We've not added the provincial tax. And if you want to know the exact figure, you can use your tax calculator. And the one I recommend is EY Tax Calculator. I will include the link below. And all you have to do is to put in your details and it will state everything for you. Please help me hit the like button if you think I'm making sense at all. Thank you. So this tax bracket is like, filling buckets of water. When the first bucket is filled up, you move over to the second one. The second one is filled up, you move over to the third one. That's how it works. Now, understanding this structure is step one. But the real magic happens when you learn how to, legally reduce your taxable income. So how can we reduce our tax legally? If you notice in your EY calculator, investment income is taxed significantly lower than your regular income. This is why investment is a powerful tool in building wealth. And apart from being taxed lower, you can even avoid paying taxes on your investment gains by using tax shielded accounts like the TFSA, RRSP, FHSA. See, your regular income is tax heavier than any other income in Canada. And unfortunately, many Canadians rely solely on their full-time job. And remember, it is not by how much you make, but how much you keep and grow. So here is the catch. You can contribute into your RRSP, that is Registered Retirement Savings Plan, or FHSA, First Home Savings Account, if you're planning to buy a home in the future. This will lower your taxable income. So this is how it works. If you make, let's say, $8,000 and you contributed $5,000 into your RRSP or your FHSA, what will happen is that $5,000 is going to reduce this $8,000 you make and bring it down to $63,000. So instead of being taxed at $68,000, you're going to be taxed at $63,000. This single smart move can give you an extra $1,000 in tax refund. It is not magic, it's just understanding the system. Next smart move is that you can open a TFSA account, tax-free savings account. And please remember, all these accounts are investment accounts, so we are not just saving money in there. So while the RRSP and the FHSA helps you to defer taxes, that is to reduce your taxes, the TFSA is going to help you to avoid taxes altogether, because the investment in your tax-free savings account grows tax-free. Meaning that, let's say you invested $5,000 into your TFSA account, and that $5,000, grows into, let's say, $10,000. You are going to keep every of that penny. You're not paying taxes. No tax on the growth and no tax when you withdraw. Another way you can reduce your tax legally is, instead of trying to, get a $10,000 raise in your salary from your full-time job and losing almost half of it in taxes, because like I said, your regular income is taxed heavily. And also remember the tax brackets, right? The marginal tax rate. What you can do is to look for a side business and pay less taxes by claiming deductions on your business expenses, on things like phone bills, internet, even part of your rent or your mortgage, depending on the kind of business. Because this is how it works. For business, you do business, make your business income, you claim business expenses, and then you file tax. I know business is not for everybody, but it is what it is. And most Canadians, they treat taxes as a once-in-a-year stuff. But in the actual sense, we should treat taxes as a strategy game whereby you plan every step, like investing and having tax efficiency in mind. Another way you can reduce your taxes by using tax credits. Tax credit reduces the tax amount you owe, usually a fixed amount. In Canada, we have a refundable and non-refundable tax credits. The non-refundable tax credit reduces the tax amount you owe, and that's it. But the refundable tax credit reduces the tax amount you're owing to zero, and whatever is remaining will be given to you, in cash as tax refund. We call it tax returns, and it benefits everyone, whether you are a low-income earner or you're a high-income earner. Let me explain further. If, say, you owe $2,000 in tax, right, and you have a non-refundable tax credit of $2,500, your tax owing will be reduced to zero, but that remaining $500, you will lose it. But if you have a refundable tax credit of same amount and owing same amount, your tax owing will be reduced to zero, and you receive a check of $500 from the government. Refundable tax credits include GST, HST, which is a quarterly payment made to low to moderate income earners in Canada to help them to offset, those GSTs and HSTs you pay on everyday purchases. The second one is Canada's Workers' Benefit, which is paid to only low-income earners. Next is Canada Child Benefit, which is a monthly payment to families that have children under 18 years old. We also have refundable medical expenses. Examples of non-refundable tax credits include basic personal amount. This means that the government allows you to keep your first $15,000 you earn without paying tax on it, and this benefits mostly low-income earners. Another non-refundable tax credit is disability tax credit, As the name implies, this is for only people that has disability. Next one is childcare expenses. So for this one, you are allowed to claim a portion of expenses you made on taking care of children that is under 16 years old. Another one is age amount, and this is for taxpayers between the ages of 65 and older. And this tax credit helps to reduce tax liability based on income. Taxes are not meant to be a punishment. Taxes are meant to be managed. So here is a recap. Track your deductions, set up your tax-free savings account and your RRSP, review your tax brackets, start a business. Please, if you find this video helpful, please don't forget to like, don't forget to comment and subscribe if you haven't. It helps me to build this channel. And please stay tuned for my next video coming up next week. Thank you all so much for watching my video, and I will see you next time. Bye.